IFRS 19, new standard. And we need to know how it is tested because the chances of it getting in our exam is quite high. So IFRS 19, subsidiaries without public accountability, tells us that we can reduce disclosures. And we can do that if, first, we are a subsidiary and our ultimate or intermediary parent provides consolidated financial statements that are publicly available in line with IFRS accounting standards. So it has to be in line with IFRS accounting standards, not anything similar. And on top of that, we as a subsidiary who wants to reduce the number of disclosures need not to have any public accountability, which means we can't have any publicly traded debt or equity. And we can't be, and here is going to be quite a hard definition, we can't hold assets in a fiduciary capacity for a broad group of outsiders as one of our primary business activities, which in plain terms means that we can't be a bank or any insurance or any other financial institution. So if these criteria, subsidiary, parent, and not public accountability, are followed, then we will reduce the disclosures. That will be very different from whatever we do in small and medium entity standard, because for small and medium entity standard, we are going to produce our accounts differently. So, for example, if IAS 23 borrowing cost would actually require us to capitalize borrowing costs that are experienced for a qualifying asset. With small and medium entity, we are not going to do that. So the numbers that two financial statements are going to have, one that uses full IFRS standards and the other that uses small and medium entity standard, will be different. In here, when we make debits and credits, when we prepare the statement of financial position, statement of profit and loss and other comprehensive income and so on, we are going to have the same numbers as if we would provide full IFRS financial statements, but the notes, the disclosures, are going to be reduced. And the standard is actually quite lengthy, so it's going to talk about each and every standard and it's going to tell us what to include, what not to include, but we need to make sure that the users of the financial statements can understand whether we are solvent, whether we are liquid. They should be able to understand our short-term cash flows, obligations, commitments, and contingencies, because that is going to impact on the risk of going concern assumption being wrong. They should understand measurement uncertainty. The amounts should still be disaggregated, so we can't show accounts payable and accounts receivable on net basis. And also, if there are accounting policy choices, so for example, if we're talking about property, plant, equipment, and we can use cost less accumulated depreciation and impairment, or we can use a revaluation model after depreciation, well, we should clearly state in our disclosures which accounting policy was chosen. So IFRS 19 reduces the notes, but doesn't change the figures. And if we are going to apply it, we will have to make this explicit statement that we do. And we're going to start applying it from a certain period. And we will have to restate the previous period, the comparative figures and the disclosures, the comparative disclosures, so that they would match the layout of current period's financial statement. And that is basically it. So as you can see, not a rocket science. And thank you for listening to me, and subscribe to learn more about SBR and how it's going to be tested. Bye.